Currently, half of the global equity market is made up of products linked to the S&P 500 index. In other words, it's a crucial component to any long-term investing strategy, and it isn't going anywhere. So let's look at 5 reasons why you should be tracking the SPX index. Reason number 1. Steady historical returns. As I was mentioning, since its inception, the SPX index has returned about 10% a year. It is widely considered to be a very efficient and very profitable product. So profitable, in fact, that over a 10-year period, about 90% of professional active fund managers will struggle to beat it. Now that 10% is an average number. So what that means is that in any given year, the actual returns of the index can swing a lot more in either direction. So the lowest it's ever gone was actually in 1931, where it dropped about 45%. And the highest it's ever gone was actually 2 years after that in 1933, where it jumped up about the same amount. But those types of swings are something that we haven't really seen since the 1930s. And nowadays, the expected volatility for the SPX is somewhere around 19 to 20%. So what that means is that in any given year, you can see the index increase by 20% or drop by 20%. Reason number 2, backtesting. So in its history, the index has been through World War I, the Great Depression, World War II, the Cold War, the dot-com bubble, the 2008 financial crash, and most recently, the COVID global pandemic, and everything else in between. So there you see the wide range of economic scenarios that the S&P, the SPX has been through, and therefore by looking at those, we have a lot of data to be able to understand how the index performs under different macroeconomic conditions, and we can make very informed decisions and predictions on what the index might do in the current macroeconomic environment. Of course, past performance can't really be indicative of future performance, but what is certain is that if history doesn't exactly repeat itself, well, it definitely rhymes with itself a little bit. And just being able to understand how the index reacted when there was big increases in oil prices, or when certain wars erupted, or when interest rates increased very much, or when inflation was really high, gives us an indication of how we might expect the index to behave today. Long story short, with this much historical data, it is probably one of the indices out there where you can make the most educated guess about how it might perform in the future. The third reason to track the SPX index is that it is, in my opinion, actually quite easy to understand, primarily because it can be used as a very effective proxy for the US economy. Now, if I was to ask you the question, do you think the SPX index will grow over the next 5 to 10 years? Do you find that answering that question is a little bit abstract? Like, where would you start looking to try and answer that question? But if I asked you the question, do you think the US economy will grow in the next 5 to 10 years? Does that feel like a bit more concise? Does it feel like you might know a bit more where to start looking to answer that question? That's how I look at the S&P 500 index. I just think of it as the US economy, and when I think about it in my head, I just tend to replace SPX with US economy to try and answer specific questions. Like, for example, interest rates going up, is that bad for the SPX? I don't know. Is it bad for the US economy? What impact do higher rates or higher inflation have on the US economy? Of course, and this is very important to be said, at the end of the day, the SPX and the US economy are two different things. And just because, again, the SPX can serve as a good proxy for the US economy, especially in the short term, that really doesn't mean that they're going to behave in the same way. But over a long period of time, and if you look at the trajectory of the growth for the US nominal GDP versus the S&P 500, if you were to plot those two on a chart, you would see that they follow pretty much exactly the same trajectory. So you don't really see many periods where one of them is shooting up and the other one is tanking down for a very long time. In the short term, they can deviate, but in the long run, they tend to move together. So when you're doing your analysis and when you're looking whether you want to buy into the S&P 500, if you replace that with US economy, and if you think about the US economy instead, I think that will be very helpful to you to really understand what it is that you're betting on and what it is that you're buying. When you're buying a fund that tracks the S&P 500 index, as we discussed before, you're buying a product into a pool of products that represents about 50% of the global equity market. So what that means is that you're buying a product that many other people are also buying and selling. And what that means is that your product is very liquid, i.e., the moment you're going to want to sell it, you're going to find sellers very quickly. In the moment when you're going to want to buy it, you're going to find buyers very quickly. So this is probably more relevant to people that want to trade in and out the S&P 500 a bit more frequently. It's nice to know that when you go online and when you click sell or click buy, you're not going to wait for days and days and days to be able to actually enter the trade. And you're going to be trading at prices that are going to look like a lot what you're actually seeing on the screen. Because nobody wants to click buy or click sell and have days go by before the sell or buy actually goes through. And then, obviously in that time, prices move and anything can happen. And the added benefit of this liquidity and this huge supply of products that track the S&P 500 is that they're very cheap. So on average, I think you'll be paying somewhere around 7 to 10 basis points a year in fees for the privilege of buying a fund that tracks the index, which is probably as cheap as investing will ever get for you. Some trading platforms like eToro or Trading 212 actually offer trading with no fees at all. So on paper, they actually do it for free, but in reality, they get their money other ways. And I'll be making videos on that specific topic separately. But just because you're not paying any fees on these platforms doesn't mean you don't get skin on every trade you make, which is pretty much how they operate and how they make money. So if you're buying through a more regular investment account, like through an ISA, for example, you will be paying somewhere around 7 to 10 basis points a year in fees, which is still pretty much nothing compared to the 10% returns that you stand to gain from it. Reason number 5, the Champions League of capitalism. Now, this final point here may make some of you cringe, but it is an important point to make. And this has to do with the type of company that will make its way into the S&P 500 index. Now, what we're looking at here is 500 of the largest, biggest, baddest US companies you can possibly find. Some of the names in there are like Amazon, Apple, Google, Disney, Coca-Cola. Now, these are companies that aren't going anywhere. These are companies that rule the world. These are companies that have all kinds of power, pricing power, economies of scale. They're built to resist pretty much any macroeconomic shock that you can possibly think of, and they do it. So when you're buying into the SPX, you're effectively buying into the Champions League of capitalism, into the companies that are the least likely to fail, into the companies that can essentially benefit from pretty much anything happening in the markets. Now, I'm not really passing any judgment here. I'm not really saying whether those big companies operate in a good or bad way. All I'm saying is that in terms of what these companies represent and what these companies are, is that they are the 500 companies that are the least likely to fail. And many of them also pay a dividend, which is also a really important part of what the S&P 500 and its performance actually is. So as I was saying before, if you just purely look at the price of and the valuation of the index over its history, it grows somewhere around 7 to 8%. But when you add the fact that the companies in it pretty much all pay regular dividends, if you take those dividends and if you were to reinvest them as they come in, that 7 to 8% growth actually becomes 10% and even a little bit more than 10% over time, right? So the fact that the companies are so big and successful and they pay dividends is actually going to have a big impact on the return that you're going to see. Thank you for watching, and if you enjoyed this content, please make sure to like, subscribe, and comment in the comment section below.